Hi, my name is Sam Wong. I've graduated with finance degree in 2.5 years. My parents were brokers in Hong Kong and I started trading since I was 15. Few of my friends would like me to share knowledge and talk about stock 101. So I'm happy to do so. So here I am. So there will be no graph in this presentation. I'll make it as simple as possible, covering the 5 W's: who, what, where, why, and when, and a few basic principles. I understand people are very busy, so I'm making the video as short as possible, cover all the major point. You can listen to your while cooking or gathering. You can send me follow-up questions or feedback is welcome. Okay, so what is stock market? The term stock market often in US referring to one of the major market index, typically referring to Dow Jones Industrial Average, S&P 500, Nasdaq, Russell 2000, Winchell 5000, etc. The stock market is a place, a platform where it enables buyers and sellers to make trades for a specific company or group of companies. When you read about the stock market, you may encounter names like I said earlier, S&P 500, Dow Jones Industrial Average. In fact, you might heard the news that the Dow Jones and Nasdaq have been surging this week, consecutive 4 days gain. And last week, Dow Jones was going down because of the worry of the coronavirus and the uncertainty of the elections. These are stock market index which help describe the performance of a market as a whole or specific piece of market. The supply and demand determine the price for each security or the levels at which the stock market participants, investors, and traders are willing to buy or sell. So you will see a bid and ask when you trade the stock. Ask is what they're trying to sell the price, and buy is what the buyer want to pay for. When you need groceries, you go to the supermarket. When you need to buy stock, then you should buy them online through the stock market. I mean, these days it's just doing things online and more convenient. Or actually, you can call the brokers as well, but normally you have to pay their brokerage fees if you call them. Each country has their own market, stock market. I mean, China have one, Hong Kong have one, India have one, and so on. There are regulations, taxes, and different rules governing how stocks can be traded. So this varies by countries as well. Let's give you some history about stock trading. The, the Dutch East Indian Company was the first popularly traded company and the first to be listed on an official stock exchange. The company sent expeditions to Asia to bring back trade goods to Europe. In the US, the first stock market was formed in Philadelphia in 1790. This was 2 years before the New York Stock Exchange, which was a physical exchange that the Nasdaq allowed, which is pretty big and more like a lead and larger cousin. Unlike the NYSE, which is New York Stock Exchange, which was a physical stock exchange, the Nasdaq allowed investors to buy and sell stock on a network of computers, a system that was faster and more transparent than in-person trading. And Nasdaq typically, when you talk about, is a lot of high-tech stock that in the Nasdaq, So that is normally what you referring to, but I mean, you could have some other stock in the Nasdaq as well. So who are the players in stock market? I mean, everything, as you know, just like playing soccer, you gotta have people, participants in there. So who are the people? Who are the participants? Corporations, right? Company actually normally have a public relations, that or the CEO will come out and kind of market their company, say how good they are, giving forecasts, answering questions the investor may have, so then they can collect funds, right? The stock market basically is a way for company to generate cash and needed to in operations. I mean, they can do issue bonds as well. As another way. Institutional investor, which typically is mutual fund insurance companies, investment banks, accounting firms, and also individual investor like you and me. Trade are executed by brokers, which are online brokers, full service brokers, floor brokers. Their market research and analysis done by called market and technical analysts. So you get a lot of researchers. Once you start to look at stock market, you can Google it. I mean, a bunch of information free. Those are done by the research analysts, and those people a lot of time will send information to institutional investors, or or support them to make the driving the decision to what stock to buy. The market was governed by Security Exchange Commission (SEC), who regulate inside trading, unfair practice, and other rules that can affect companies' operations. So, after I said that, now you get a good understanding of what your stock market, where it was coming from, and the history about it. Then you will ask next question. Well, really the key of this training section: why invest in stock market, right? So, number one reason, stock market is highly liquid. What it means is you can buy it right away, and the next minute you can sell it. Then you can go and convert back to cash. It's very easy, high liquidity to convert to cash. So unless the market crash, which you see $10, something drop it to $7, $6, pretty stable, then you can sell around the same price. Then you convert and change that money back to your bank account. So also stock market, in historically spoken, it gives you about 10 to 12% return every year, depending on which index you're looking at and what time period you're referencing to. Some year office a little higher, some year a little lower, but you still, if you look at long range, about 15 to 20 years ranges, and looking at what is the average return, it gives you about 10 to 12%. So for the same amount of money, if you put in the bank, you know that you get less than, CD right now at the moment, you probably get less than 1% of return, right, as interest. And then you can also buy, security, treasury bond. But right now, you know that the rate is much lower than the pandemic. And also, there's some, you can put money in real estate, right? That's another options, right? If you look at opportunity to invest, well, but the problem of real estate is that you need a much larger capital, right? And then you also need to manage it. You're gonna find somebody to manage that real estate for you, which costs fees, right? And then the challenge as well is if you hear the news recently, right? I mean that people actually don't have jobs and that they default and not able to pay rent. So you actually can run the situation that you rent a place to somebody else and you cannot collect your return, right? So there's a risk there. You can also sell properties and it takes a little longer. So still, I mean, there's liquidity is there, but you could be sitting a month or two before you can sell, or you have to actually give a discount, and you could lose money on the property. So you can buy it for $300,000 as an example, but you end up nobody willing to pay for that, so you have to buy it, sell it at $275,000, which is $25,000 losses. Plus, during the year you own the property, you actually incur property tax and other maintenance. So I mean, there are things to price into managing or owning a real estate as investment. I'm not getting into detail on that. Right? So, and then the other good thing is investing in stock. You literally can be penny. That's why they call penny stock. There's a lot listed in penny stock that you can trade and buy. So I'm almost referring to small stock, and then you can buy those, which is really cheap, less than $10. There's some really less than $2. You can buy that too as a startup companies. And also you can look at the recently, you probably hear the news about Apple, Amazon, Zoom. These stocks have been actually more than a double, since beginning of the year. So if you hold a stock at the beginning of January 1st, and at this point you look at it, even last week when the market was down 1,800 points and down, you still have a very great and good return that basically you cannot get it anywhere else. So there are also some financial tools and methods that you actually can hedge against the losses because they're risk for return, unlike buying treasury bond, which is risk-free. I mean, stock, you're buying, investing in a company, it does have stock risk. The company can go bankruptcy. So now your paper, this stock security doesn't worth anything anymore. So, and then again, I'm not going into detail on this, but I can actually do another video and go through one specific example and some history behind, when the recessions are booming, which stock do better and so on. Right? Company also give dividends. That's another advantage. A dividend is a distribution of some of the company earning to a class of shareholders, which is determined by the company's board of directors. So I can give you a couple of examples. In an oil giant company, Exxon, they give a dividend of roughly 3%, and Apple typically give you about 1 to 2%, for dividends. So actually, it's still better than if you put it in the bank. So next question is when to buy stock. So this is actually the most difficult question above all. Some people believe that you should buy stock in recession. But in reality, if you look at the stock market, every day, there's always market volatility. Every day, there are gainers and losers. So you just, matter of how to choose it, right? Let's use this analogy, right? So if consumer always looking for a deal, right? You always want, for example, Prime Day, Amazon, they give you discount, Black Friday, you go and buy those during that time because you're looking for discount during that time and you think that's a good deal. So same thing with stock market. The mindset should be really applying to the stock market as well. The only problem is you actually have psychology ran into it, right? So if the market like last week, it keep going down and down, people will start panicking, worry about it, thinking if stock will overvalue, is this really a correction or market crash? So what if I buy it and the stock continue to sleep, right? But so the key is you have to pick the stock that you believe is good. You really have the value carry forward in long term. Then ultimately you will be winner and you make money. So also the tools to analyzing that, which call they do look at discounted cash flow DCF analysis, which takes a company future projected cash flow and then discount them back to the present using a reasonable risk factor. Also, you have to look at the company balance sheet, look at their other numbers that in the financial result that use it for considerations. I'm not going to get into details in this section because you can spend another 10 or 15 minutes just to talk about that kind of stuff to get you better understanding of stock valuations. So the next thing I want to do is give you some basic principle in investment. The higher the risk, the higher the return. This theory has been proven mathematically, using alpha and beta. And then there are two types of risk called systematic and non-systematic. Non-systematic is type of risk that not predictable or impossible to completely avoid. For example, interest rates risk, liquidity risk. Okay, diversification. That you often heard that don't put money into all your money into one basket. So that's literally what it means in diversification. You will buy a different kind of stock and diversify your portfolio so that if one industry not doing well, the other one kind of offset and help you. For the best effect, investor probably would like to invest up to 20 stock. Then after that, there's something called law of diminishing return. So it's also proven that you're not getting as much benefit for diversifying. If you buy another up to 100 stock, 200 stock, you're really not going to help you much. And then in a traditional trade, investor make money called buy low, sell high, which is very traditional. You buy $100. The stock go up to $120, you sell it, you make $20. That's simple. But these days now, people will do sell high, buy low, which you'll probably hear the term called sell short or buy the stock to recover. I'm not going to cover in this subject in this training section. I can have a separate one because this again you can go to another 10 or 15 minutes discussion with examples. There are two types of analysis. One called fundamental, which looking at revenue and profit and losses for valuation purposes. So you heard a term, Amazon may be overvalued. So they're using the fundamental method and determine that using the numbers and discounted cash flow to say, hey, whether the stock really worth $3,300 right now a share. And then the other method is called technical. All it is using chart. They're studying behavior of chart to know 50 days average, 200 days average, whether the break points is, whether this is K-cup to buy and it's a dip. I'm not getting into that kind of detail, just to give you an idea. Normally, a lot of traders would like to use that technical methodology to determine the stock to be bought. Okay, so last section I want to cover on this training session, how to get started. So what you need to do is open investing or brokerage account. There are a lot of companies now offering free accounts, so you need to take a look and researching it. I'm so sure one of them you heard recently called Robinhood. So they have been searching and increasing users. Well, one thing I do want to make you caution about Robinhood is they do have a security fraud issue just a couple of weeks ago. So you have to be very careful about Robinhood. And I hope that it will not ever happen if you decide to open an account in Robinhood. Also, Robinhood cannot trade over-the-counter stock. So what is over-the-counter stock? It is actually a traded security for a company that not listed in a formal exchange. So I can give you an example like some China stock. They are not listed in the NYMEX with NYMEX, but which is New York Stock Exchange, but in OTC. And in that particular case, you have to pay fees. So I have an Ameritrade, which I set up a long time ago, which actually was Scottrade and Ameritrade bought them out. When I opened it, it was required to open $500 a minimum. It does have to pay security commission. Every time I trade, I have to pay $6.95 or $6. It was started at like $11 and drop. Now it's actually free. So the reason why the volume, if you look at stock market, it actually continue going up in recent years, and more individual investors come into it because now the way the fees is really good. Because think about it, I just mentioned earlier that people with little money, like $100. Well, if you only have $100 to buy some penny stock, $10, $5, whatever, well, you really can't afford to pay $6.95 a trade. That's just a buy. When you sell, you pay another $6.95. Then that's $13. That eat up your rate of return when you only have $100, because that's 13% return just to the quick math, right? So this is actually very encouraging when the company, the brokerage company no longer, charging you for fees. It really create a lot of more motivation. Like you could have buy 100 shares of stock as X price, but you don't want to sell all 100 shares. You can just sell 5 shares when the price go up $5, then sell another 5 shares when the stock go up another $5 and so on, and then you don't have to pay for fee. So the return is much better than what it is. And then also I encourage you to set up electronic payments transfer, which then you can get your cash quicker. Otherwise, they will mail you a check if you withdraw money from your brokerage account, which will take 2 to 5 days just to mail it to you. Then you have to deposit in it, right? And then so basically, you set it up. Once you set it up, first time you enter the username and password. They will ask you to change a different password. Then good to go. So you can buy a single share or a few shares. The key to decide though is really decide which stock you want to buy, right? So you need to do research, or you can just open the account for now. Good to go. Have some money in there. Then you go research. Once you're good ready, you buy it, and then also budget how much money you can afford to lose. I'll use that way, which typically is not the case, but because you expect to make money off of it. And some people will actually use weighted average methodology. So what it means is every month they will put $100 or whatever some amount aside and just put and buy the stock they want and keep buying them. So then the stock market is go up and down. So at the end of the day, you take a weighted average of that as your cost. So then if the market go up, higher than the weighted average, you make money off of it, right? So the other concept I didn't mention earlier too, called realized gain and unrealized gain. So even though your account, you can see $5,000 there, buying some stock and make money, you're very excited. You make 20% return after $5,000, just an example. Well, you don't really pocket the money until you sell the stock. So this is something very important you must understand, because the market changes every day when as soon as the price changes, right? So not until you sell the stock, you cannot really say, hey, I make XYZ amount of money. And for that kind of thing, if you make money, you call that I make unrealized gains. I mean, again, this is getting the more trader mentality. They have report to really pick it in realized gain, unrealized gain, then do a mark-to-market calculations, figure out where they are at, and it's more technical, If you like what I just said in the video, please don't forget to subscribe and click the bell so you get the other videos that I'm gonna upload. Again, thank you for your support. I hope you're enjoying it. If you have any questions, feel free to email me, or again, feedback is also appreciated.